Silver just got hit in a way that made every trader, investor, and watcher of the market pause and double-check their screens. You know the moment I'm talking about. The kind where you squint at the numbers and think, wait, is this real? Immediately, fingers started pointing online, blaming manipulation, conspiracy, and market villains. I wasn't planning on making this video today. I had my jacket on, coffee sitting cold, and I was trying to have a quiet morning. But my phone started buzzing like it had a life of its own. I looked at the silver charts and thought, something unusual just happened here. And you know what frustrates me the most? The loudest story is almost always the wrong story. So today, I'm going to give you the full, unfiltered breakdown, how silver really moves, why it reacts this violently, and how to separate the noise from the mechanics. Stick with me. It's Saturday, February 7th, New York time. I want to see where everyone is watching from, so drop the day and date in the comments. Let's see how global this audience really is. Yesterday's move wasn't just a little dip, it was a hard slam. Silver fell in the high teens percentage-wise and landed somewhere in the low 70s per ounce. And the reaction online? People didn't ask, how did this happen? They jumped straight to, who caused this? I understand the instinct. A drop that sharp doesn't feel like a normal market fluctuation. It feels like someone yanked the rug out. But here's the key. When you start by blaming a villain, you stop analyzing the mechanics. And make no mistake, silver is one of the most mechanical markets in existence. Its behavior can be explained with models, data, and market structure, not by pointing fingers. The moment this became a full-blown viral story wasn't actually the price drop. It was the math that came after it. A post went around claiming this was a sigma-hour freak event, and then people started throwing around numbers meant to make you feel small. It suggested that a move this extreme should only happen once in a cosmic timeline. Then, as viral content loves to do, it added a second, scarier claim, that this kind of paper market move guarantees the main futures venue will fail in March. Thousands shared it, not because they verified it, but because it sounded certain. Sigma, trillions, failing, March. That's a sentence built for clicks. But let's slow down and think critically. A viewer named Jason asked the exact right question. Isn't that assuming a normal distribution? And the answer is yes. That rarity math only works if you assume returns behave like a neat bell curve where extremes almost never happen. Silver doesn't play by those rules. It has what statisticians call fat tails, which is just a fancy way of saying extreme moves happen more often than you'd expect from a standard model. So when someone tells you this kind of drop should only happen once in a lifetime, you need to ask, based on what assumption? If the assumption is wrong, the conclusion is fantasy. Now, let's be clear. Saying silver has fat tails doesn't mean foul play never occurs. It also doesn't mean you should stop questioning anything. It simply means you can't prove manipulation with a viral Sigma meme. Evidence has to survive sunlight, patterns, incentives, repeatability, real data, not a single post with a giant number. The reason Sigma memes spread so fast is emotional. They make people feel comforted, like the move wasn't their fault. It's not you, it's the system, they say. Comforting? Yes. Useful? Not really. So here's what I want to do today. Break down the 6 main engines that drive silver's volatility, in a way that mirrors how the market really behaves in real time. The market doesn't move in neat sequential chapters. And yes, we will cover manipulation in a future video, looking at real-world signals and data, separating them from hype. But before we even talk about manipulation, we have to understand volatility. Otherwise, every sharp move just looks like sabotage and will never get past the headlines. Engine 1. The tradable float is small. People love to say, there's so much silver above ground. And yes, there's silver in electronics, jewelry, industrial components, and even in warehouses nobody checks. But most of it isn't in active circulation. The part that responds quickly to price, the part you can buy or sell without melting it down, is very small. And here's the kicker. Ounces don't move markets. Dollars do. You can have mountains of silver and still be fragile if the dollar value of the tradable pool is small compared to the capital that can hit it. Gold, by comparison, is a much deeper pool in dollar terms. When a large order hits a smaller silver pool, It doesn't ripple, it splashes. Engine 2. Supply is slow and inflexible. A significant portion of silver comes as a byproduct of mining other metals. That means production isn't instantly responsive to price changes. You can't just double output overnight. Mining projects take time, permits take time, financing takes time. And when financing conditions tighten, starting new projects gets even harder. So even if silver price spikes, supply doesn't cushion the move quickly, leaving the market exposed to swings. Engine 3. Demand is split, and that split causes whiplash. Silver has two very different audiences, industrial and investment. Industrial buyers care about continuity. They buy based on actual use and manage risk with hedges. Investment buyers react to narrative, interest rates, inflation, momentum, and fear. When the market flips from risk on to risk off, silver gets tugged in both directions. Hedging flows can even look like bearish selling, even if nobody is truly bearish. Engine 4. Paper pricing dominates. The silver price you see on your screen isn't negotiated one bar at a time. It's discovered where contracts trade. Paper is not inherently bad. It provides liquidity and allows hedging, but it amplifies every move through leverage. Small gains and losses can create massive reactions, and funding cost shifts, cross-market shocks, and liquidity cycles all hit silver harder than thicker markets like gold. Engine 5. The trapdoor effect. This is the chain reaction that turns a routine down day into a historic-looking flush. Stop losses fire, margins get stressed, forced liquidation happens, and hedging flows all pile on top of each other. One level breaks, and it cascades down. No mastermind required, just mechanical interactions amplified by leverage. Exchanges sometimes raise margin requirements, accelerating the move further. Leverage is renting, and the landlord can change the rules. Engine 6. Silver has an identity crisis. Sometimes it trades like a monetary metal, moving with real yields, currency confidence, and gold-like sentiment. Sometimes it trades like a commodity, tracking manufacturing, industrial activity, and growth risk. Switching between these regimes is where violent swings happen. Positions must unwind quickly, and in a thin market with leverage, the result is rapid, painful moves that feel like the floor disappeared. So why do Sigma memes appear after big moves? People want certainty, and math looks scientific. They turn emotion into a formula. This is impossible. Impossible feels cleaner than risky. But markets aren't labs, they're crowds. And crowds don't distribute like a bell curve when exits are narrow. Thin liquidity plus synchronized action creates gaps, jumps, and tails. History shows silver has more extreme days than a normal model predicts. That's arithmetic, not opinion. What about the claim that the futures venue will fail in March? Could there be stress in delivery systems? Yes. Could participants struggle to source metal? Yes. Could rules change? Yes. But guaranteed failure is a different claim altogether. That's what people say when they want others to stop thinking. Always ask, what does fail even mean? Without a clear definition, a claim can only be shared. It can't be analyzed. So what should you do? First, don't let viral posts hijack your emotions. Treat giant sigma numbers like flashy thumbnails, not foundations. Second, understand that silver is a structured market. Thin float, high leverage, paper dominance, forced selling, all can create extreme moves without a single bad actor. Third, watch macro context. Yields, dollar, equity volatility, liquidity. Fourth, paper and physical don't always move together. Transport, storage, insurance, and time introduce friction, making arbitrage slower. And fifth, volatility cuts both ways. The same structure that makes silver crash fast can also make it rally fast. Position sizing isn't boring, it's survival. If you found this useful, subscribe and share this with someone spiraling after the move. They probably need the mechanics more than the outrage. Drop a comment below. Tell me where you're watching from, what surprised you the most about silver's move, or which volatility engine caught you off guard. And as always, this is for education and entertainment. I'm not your financial advisor. I don't know your situation, goals, risk tolerance, or what you can sleep with at night. Make your own decisions, double-check everything, And if you need personalized advice, consult a qualified professional.